Hello and welcome. Great to have your company on 𝐾𝐿 TV. I'm Holly and you're watching The Buzzing Trends, a specially curated show that brings you emerging trends driving the market momentum. Before we kick things off, let me give you a highlight of what we're going to touch on today. In the first segment of our show, we'll be looking at the market expectations from the earnings reports from businesses, particularly metal and mining ones. This is when ongoing reporting season is grabbing the market attention as a reliable barometer to gauge a company's operational and financial footing. Next up, we'll be zooming our lens on over to the 4 ASX-listed mining stocks that have beaten guidance for the financial year 21. So without further ado, let's get started. In Australia, the market is looking forward to the reporting season that'll get into full gear starting in August, with analysts anticipating a mixed bag of results from different sectors. The market is particularly eyeing reasonable earnings from metal and mining players. Analysts expect that miners may also lift their dividend payouts while benefiting from buoyant resource prices over the last year. At the same time, it'll be interesting to see to what extent miners will feel the pinch on their earnings amid changing dynamics of the commodity supercycle. Well, in the commodities market, iron ore has garnered immense attention after China shared its plans to accelerate domestic iron ore exploration in order to secure local supply. While China is planning to implement new iron ore supply strategies, the commodity market seems to be more concerned over forecasted steel output decline in China. Meanwhile, on the global surge in a new variant of coronavirus with a record number of cases in Britain, which is posing a potential threat to the demand on the base metal. China's move to tighten the grip on exorbitant commodity prices is another headwind for iron ore prices. Plus, gold's appeal as a safe haven is facing a tug-of-war between economic revival prospects dimming the charm while inflation expectations are still keeping investors glued to the yellow metal. So let's keep an eye on the earnings updates from selected miners. Moving on now to our second segment of the show and looking at the prominent resource stocks. First up on our list is Fortescue Metals, one of the world's leading iron ore companies. The company witnessed record quarterly shipments in the June quarter. Fortescue delivered exceptional results with a record quarterly shipment of 49 million tonnes. This is one of the highest quarterly contributions, resulting in the highest ever annual shipments of 182 million tonnes in the financial year 21, beating its upper guidance range of iron ore shipments. On top of that, the miner achieved C1 annual cost guidance in line with the guidance range. For the unfamiliar, C1 cost is known as the direct cost of production at site level. This includes costs incurred in mining and processing, such as labor, power, materials, along with transport, refining, and administration costs and royalties. Overall, looking at the charts, Fortescue Metals has delivered a very handsome return of 47% over the last year, as of the 29th of July. And next up is Sandfire Resources, an Australian-based mid-tier exploration and mining company under the spotlight for delivering outstanding operational and financial results for the 3 months to June 2021. It reported exceptional performance from its flagship De Grasser project. Notably, amid surging copper prices, the company's annual copper production surpassed the guidance range, while gold production remained near the upper end of the guidance range. On the stock performance front, Sandfire Resources has delivered a very nice return of 30% this year as of the 29th of July. Well, it's now time for a short break on 𝐾𝐿 TV, but stay with us because I'll be right back to look more in depth at the earnings updates of 2 more miners. Welcome back, I'm Holly and you're watching the Buzzing Trends. We have the spotlight on some buzzing mining stocks today. 𝐊𝐴N Resources has made headways in the June quarter. The Australia-based gold producer is focused on its Tomingley gold operations in New South Wales. 𝐊𝐴N has produced roughly 57,000 ounces of gold in the financial year 21, significantly up from the guidance range of 50 to 55,000 ounces. The AISC for the financial year was slightly below the lower end of the guidance limit. And in case you weren't sure, AISC, or the all-in sustaining cost, is an advanced metrics used by mining companies to report the cost of their mining. Overall, looking at the charts, 𝐊𝐴N Resources has delivered a solid return of 20% this year as of the 29th of July. And the last miner that deserves special attention in our Buzzing Trends show is Evolution Mining. Australia growth-focused gold miner with the flagship assets in Australia and Canada. The group gold production for the financial year stood at roughly 681,000 ounces, compared with the original guidance range of 670 to 730,000 ounces. However, the miner stayed behind the revised guidance of 695,000 to 710,000 issued in April of this year. The AISC of $1,215 per ounce also stayed within the range advised of $1,190 to $1,220 per ounce. And on the stock performance front, Evolution Mining has delivered a negative return of 20% this year, as of the 29th of July. Well, we all know overall earnings updates are important to keep track of, but let me break down why. Earnings season is an important time for investors who take portfolio decisions based on beat versus misses of the business results with respect to the market expectations. Review of a company's earnings plays an important role in the assessment of the intrinsic value of its stock. And amid potential commodities superboom, the mining space and the earnings update and guidance need to be closely evaluated. Alright viewers, I hope you like the show, but stay tuned because we have another Buzzing Trends show at around 3:30 p.m. today with our presenter James Preston bringing more interesting market trends for you. Holly Shields signing off.